How big a shock was this? This review obviously was on for a reason. We have a dollar figure, and clearly the market is not enjoying what it's seeing.
Everything happened pretty fast. I mean, they only started this review a couple of weeks ago. Laplanche founded LendingClub about in 2007, and he took it public. It had a huge rise, and then in recent weeks they've had kind of a bigger fall as they've had to raise rates, and they've had a whole bunch of other problems. But this was completely out of nowhere and a huge shock for most investors.
What does it say about the space? Because the valuations of a lot of companies like this, these alternative lenders, really have come off. Are there new skepticisms out there in general about these businesses?
We don't really know yet. I mean, Washington has had kind of a closer eye on these new lenders as they emerge and as they grow. They're beginning to securitize their loans. But something interesting, I mean, this was $22 million worth of loans to a single investor. Our sources have said this morning, we found out who the investor was. It was Jefferies. So it'll be very interesting to see if there's more kind of, if this goes a little further than that.
Yeah, just reading the headlines, what's been said so far, it's not like there's been a big default or there's some wrongdoing as such. It's that it was against all their principles. The question really is, does this give more impetus to regulators?
We'll see what happens next. I mean, this just broke this morning. We don't know how regulators are going to view the news. This was an internal review. So, I mean, they caught the problem themselves, and then they brought it, and they're not giving guidance anymore until they figure out how to sort out the situation. So we'll kind of see even how the company deals with it, let alone regulators.
Seth, what do you make of that it's one big client that happens to be Jefferies? I feel as though this story has some legs in terms of what we learn about it. But
I think the real problem is the space, quite frankly. There's been over 500 of these online lending platforms funded by the venture capitalists out on the West Coast, and they're all fighting for the same loans. So, you've seen the loan loss ratio go up, and you've seen the shares of this sector get hammered so far this year. And I think that people are trying to find other ways to profit from this business and prop up their stock price. So we might find some other, nasty things coming out of the woodwork.
I don't want to have sour grapes about losing the chart of the day competition, but Matt Miller's chart speaks exactly that, right? If loan officers are tightening up, these are exactly the place that these businesses are operating.
And we'll see the shares also. There's On Deck Capital this morning too. We'll see the shares of that as well. I mean, if that's moving in tandem with the LendingClub or not. Mm-hmm.
What does this say about the wider space, not just for internet lending, but just credit in general? The amount of people chasing the same deals. Is there a read across there?
Well, I think that absolutely. You have a typical environment out on the West Coast with venture capitalists where you see a hot sector. So you have a ton of copycats coming in. And at this point, they're going after the same borrowers. And there's a real competition. And anytime that happens, you've seen it from the largest borrowers, and certainly you're seeing it from these new online lending platforms, that the creditworthiness declines.